So today we are going to talk about Canadian mortgage changes, qualification changes that happened just 2 days ago. Those changes, you might have seen a video earlier before me. That video, basically, I explained very briefly within 1 minute session that what changes are coming in as of June 1st within Canadian mortgages, right? So within Canadian mortgages, if you have any questions, feel free to type in. I will try my best to answer them as soon as possible. Again, this is my first live session. I will try my best to go through the screen very quickly. So I will summarize very quickly what the changes are. In April, or let's say even go further more back, many years ago, like let's say I think it was 2017, I don't remember the exact date, 2017 or 2016, when the stress test was introduced by Government of Canada. So stress test is basically a very commonly used term, but many people are not aware what exactly this means. So stress test is basically, let's say your interest rate as the customer, let's say your interest rate is 2% or 1.5%, and your monthly payment is $1,500, let's say. That's your actual payment that you have to monthly make on the mortgage. But when you're qualifying for a mortgage, you have to qualify at a higher monthly payment, which means you have been stressed out that if you could afford that higher payment. So that interest rate had changed in the past, basically a couple of times gone up and down. Recently, that number was 4.79. So even if your interest rate was 1.5% and your payments were $1,500 let's say, right? Example, you were stressed, basically your mortgage qualification was stressed at 4.79, and the government or the banks wanted to make sure that you could qualify for that mortgage payment if the interest rates go up to a certain number. That was the intention. So that's why the 4.79 interest rate was basically in the last 1 year window was there always. At one point it was 5.24, then it decreased to 5.10, then it decreased to 4.94, and recently it was at 4.79. So every time, whenever a new applicant or refinance application or anything was happening, they were basically stress testing your application that you could afford a lower monthly payment or let's say a higher monthly payment, and then they were approving you for that mortgage. That is basically a stress test. So what happened is, in April this year, Government of Canada, OSFI, there's a department, OSFI, Office of the Superintendent of the Financial Institutions. That department basically said they are going to increase the stress test rules for the uninsured mortgages, which means uninsured mortgages means the mortgages that are 20% or higher than that down payment. And basically they basically wanted to increase that number from 4.79 to minimum 5.25, or the customer rate plus 2%, whichever is higher. That was the announcement that came in basically in April, that it would be effective in June. But 2 days ago, Department of Finance Minister of Canada, she basically announced that she will follow the exact rules that were made for uninsured mortgages, the 20% or higher than 20% down payment mortgages. They will make the same rules for the mortgages from 5 to 19%, the insured mortgages also. Same rules will apply to the insured mortgages also. That was basically decision Department of Finance, Government of Canada made. So what does it mean? It means your buying power will go down. That's the only thing. You will still qualify. There's nothing wrong. As I mentioned earlier, maybe 1.5 years ago, that same interest rate, qualifying interest rate, was 5.24. So June 1st, it would be 5.25. So people were qualifying in the past at 5.24 or 4.94 or 5.10. The only difference is that the straightforward, they went up from 4.79 to 5.25 now, or the customer rate plus 2%, whichever is higher. Guys, welcome, whosoever has joined us. Thank you. And moving further, so 5.25 means now if in Edmonton, I will take the example of Edmonton or Calgary, if you are purchasing a property and you're putting the minimum down payment, no other debts, then your income, basically whatever your income is, consistent income, you're qualifying for, let's say, $500,000 property. Now, after June 1st, you would be qualifying for, let's say, 475, roughly 5% reduction in that. So that's basically the whole scenario. In mortgages will still keep on going. People will still find ways to get a mortgage and income and down payment, right? Things have changed. Many different things have changed in the past. I would say since I have been in the industry, July 2006, and I have seen many different times, many changes come in, but people adapt and they move from there, right? So I do see a question, how do I get a mortgage? So how do I get a mortgage? Basically, there are three factors involved into this one. The first one is income. Second one is down payment. And the third one is a credit history. So if you have all these three things checked in, down payment, credit history, and the income, and you meet the parameters, you would be able to qualify for the mortgage. Again, we can discuss in detail. I would request if you have more detailed questions, you can go in and we can do a preliminary calculation for you over the phone and then go from there. So moving further, on the same question, when you need basically down payment, you need to have minimum 90 days saved up on that down payment in your bank accounts. That's one of the requirements coming in. Then the next one is income, same thing, 3 months history minimum. You should be working at workplace, minimum 3 months old job, and credit history. So credit history is, what it does mean is, you should have minimum 2 trade lines established on your credit history. 2 credit cards, 1 credit card, 1 loan, 1 credit card, 1 line of credit, something like that. Minimum for 24 months, 2 trades. Okay, hi guys, welcome. So that's the minimum requirement. The question that you have asked is, how do I get a mortgage? This is one of the minimum requirement, or I would say 3 of the minimum requirements: income, down payment, and credit history. You can call us at 780-994-7454, and the number is already in the bio section of my profile. Or I would recommend you to approach a local mortgage broker, and he or she would be the best person to guide you further. Hi Gia, welcome. So moving further, recently I was basically on let's say web conference. Okay, here's a question: isn't it 30 days history for down payment needed? Does that depend on province too? That's a very good question, Mahko Preet. Definitely there are some lenders who could qualify you on a 30-day history, but majority of the lenders require 90-day bank history. So 90-day bank history means consistently you have saved that money. You don't need to have, let's say $15,000 is required for your $300,000 purchase, a condo, right? You don't need to have $15,000 day one. You could show the bank that you gradually saved that money and reached $15,000 in the last 90-day window. I hope I'm answering your question. What I mean to say is, what the banks mean to say is 90-day or 30-day, is they don't want to see a sudden deposit into your bank account which you cannot explain. And that's the reason why they would like to see some history. Normally, as I said earlier, majority of the lenders require 90-day bank statements. I know one lender that I can deal with every day, basically can work out with 30-day window down payment history, but sometimes the same lender I have seen, they have asked for more number of days on the down payment. Having said that, I do not know what's your status in Canada. Let's say if you are a work permit person, which I have seen many different times, they have not saved the money, the down payment is not in their bank account, and then suddenly money is coming from overseas, India, Pakistan, and every other country in the world. That's a big no, especially in the work permit case scenarios. The work permit applications are always considered as new to Canada applicants, and they need to have minimum 5% saved up, and it should be their own resources. Again, I would always recommend a 90-day history. So I hope this answers your question. Down payment, again, this is I'm thankful for this person to ask this question. In my 16-17-year experience, down payment is one of the, I would say, one of the topic that any applicants, basically they treat it very lightly. They think that they can deposit the money any day, any time into your bank account, and the bank should be okay with it. Bank will never question. But I have seen files declined because of down payment, because the clients did not manage their down payment properly, or they did not disclose properly where the money was coming in. People always think that income and credit history is the only one issue, but down payment is another one of the major thing, which is very much equal partner in your mortgage application approval. So always make sure your down payment is in line, 90-day statement is there. And if you're putting money in RRSPs, whichever way it is, TFSAs, you have access to that money. You can cash that money. It's not locked in, right? So if it is locked in, let's say it shows up in a GIC and it's locked in, then the bank will question, how will you cash this money, right? So yeah, hope this makes sense. Yeah, so moving further, any other questions, most welcome. You're welcome to ask me. As I was mentioning earlier, I wrote down some notes over here. Recently, I was on a web conference with Benjamin Tal, and many of my other friends from the broker community were. Benjamin Tal is a CIBC chief economist. He was basically talking about how the economy and everything will be working in the coming, let's say, 1 to 2 year window. First thing when he started, again, I'm quoting his things over here. These are not my predictions. I'm quoting him when I'm talking about these numbers and the statements, what he made. The biggest thing that he mentioned, again, we all know, nobody has a crystal ball to tell how the economy and the interest rates and everything will happen. Inflation, he talked about inflation. Nobody knows that, right? So the biggest thing that he talked about was COVID-19 crisis and the impacts of it, and how the housing economy and the Canadian economy will get out of it. The biggest answer that I heard was vaccine. He was a pro-vaccine guy. He is a pro-vaccine guy, and he said vaccine would be the only answer, where people have herd immunity, majority of the people have vaccinated, then only Canadian provinces. I'm in Alberta, and I know there are sections I have to wear a mask to meet people, and I'm pretty much sure all across Canada is similar stuff. So he was asked by the Department of Finance, finance minister, she asked him, what do you think, like, how would you spend, like, I will share more things over here. So she asked him, what would you basically tell, the question was, what would you tell how Canadians should spend their money, the money that they're saving right now, the money they're sitting in their bank account, the people are not spending. He told her, get them the vaccine and get out of the way. Provide them the vaccine and get out of the way, which means that if everybody's vaccinated, then people will get out, spend money, restaurants would be back in line, everything would be back in line, and the service sector would be back, and the economy would be back in line, right? So his thinking is that by the end of June, or let's say middle of July, in US, so this is US history that he's talking about, because we are tied up to US so much. Our trade partner is US. 60 to 70% of our exports are going to US. So his thinking, his predictions, or let's say his talk was, by the end of June this year, US will be able to come up to the herd immunity status. That's what he is thinking, and that's why he said the vaccine is working slowly. It's working. And that's the reason why it will lead to the opening up of the whole economy, and then we can go from there, right? He also talked about that Canada is not behind. Canada is a little bit behind because we started late. And if we started late, then we will catch up. But again, we are basically 3 to 4 months behind US numbers. And that's what he was basically talking about, that it will take us 3 to 4 months to catch up to what US has been doing in the past few months, right? So, but again, vaccine was one of the main thing he talked about. Now, he basically thinks, Benjamin Tal, again, the CIBC chief economist, he basically thinks that in the second half of this year, things would be a little bit back to normal. Or let's say more back to normal. There are 3 reasons why he thinks, why is that? And I will share with you the more reasons coming further in the video. So he says the nature of the recession, the crisis, is totally different than the previous recessions that we have seen in 2008 or earlier, right? This recession was mainly the service industry recession. It was not a goods industry recession. Goods industry was really doing good, but it was a service industry that was struggling. The hotels, restaurants, they have felt the pain. And this recession is more deep for them. They have felt the pain, but it is also narrow. It has not impacted many different industries. So like the previous recessions where it was all across the board, right? So his point was, like, this recession, service industry is all seeing all the damage, and they are more affected by this recession. As I mentioned, the hotel industry, airline industry, all that stuff. So what his point was, service industry will rebound back. How it will rebound back is as soon as people will spend the money. So he was talking about that in Canada, as of today, the most jobs that were lost were low-paying jobs. People who were renting, those people lost the jobs. The people who were in the middle income or the higher income, their number of people losing their jobs was very less. So his point was, those people with the high income, in the personal side, he gave us a number. It is basically a skyrocketing number that people are holding on to that cash. It's sitting in their bank accounts. They're not spending that money. I believe it was close to $100 billion money that is sitting in their bank accounts, in the checking and savings accounts, that is not earning any interest. And people are not spending it. People are cautious about their spending because they're scared, as per the last year's crisis, right? So his point was, as soon as people will spend money, that money will come back to the service sector, restaurants, and everything, and the economy will go up. That was his main point. Then he also talked about the businesses. First, the individuals like you and me who are basically holding on to the cash and not spending the money. Then he also talked about the businesses that are not spending the money. So according to his calculations, Canadian businesses are sitting on $130 billion cash right now, which they are not spending. So total $230 billion cash, Canadians are holding on to it. It's sitting in their bank accounts, maybe a checking savings account, and people are not spending because people are afraid. And I am one of them, right? So, and his point was, as soon as this money is back into the market, then the economy will be back on track, right? People, the biggest thing I will tie it up to the vaccine section. He is urging the governments to bring the vaccine back to each and every individual as fast as it could be, both doses, first and second doses, so that there's a green light. He kept on talking about the green light, the green light. The people are waiting for the green light. That as soon as there is green light, people are going back to their normalcy, which is a normal thing, and then the economy obviously will be back. If people will be kept inside, obviously the economy will not work. That's what his point was. His point was that the higher income families, people who were earning very high income of number of, let's say, dollar value every year, they are holding on to the majority of the cash. 75% of those Canadians are holding on to that cash. They're not spending it. And the low-income families, which were very much just worried about their shelter cost, food cost, they have to spend. They have no other, they have to survive. They have to spend that money. Whether it was the government money they were getting from federal government, from CERB or any other benefits they were getting, they have to spend. So this is the reason why the vaccine is important, the normalcy is more important, so that the businesses and the individuals that are holding onto the cash, they can basically go in and spend it. His famous line was, people are dying to go to a restaurant. He said, people are dying to go to a restaurant, but they are not willing to die doing so. Which it totally makes sense to me, that why people will be, if people are scared, why would they go back to, let's say, they're scared of the virus. The fear has to go out, and that's the reason when the economy will go back, right? The vaccine is one of the answers, as I said earlier, right? So moving further, he also talked about who will pay for all the services, all the benefits that we got from Government of Canada, the money that we got from Government of Canada, the $2,000 CERB and other benefits. That his point was, who is actually going to pay? And his point was that you and me, both of us, we are going to pay at the end. And he was giving examples of US, UK, where Biden and the UK government has already started talking about raising taxes. So those taxes will be basically covering up for the coming years, right? When the taxes will go up. Another thing was that after the election, so he's talking about some kind of election, and there's another talk that election, maybe there would be a fall election in Canada. So his point was, whichever government comes in fall, after fall election Canada, they will be raising those taxes, and those taxes would be either the corporate taxes will go up. He was taking example of UK government raised the corporate taxes and covered up for all the services that they have provided, right? So, or one other thing that will really impact you and me is the GST. So he was talking, Benjamin, the people who are joining me, I will repeat again. I'm talking about the quotes from Benjamin Tal. He is a CIBC economist. Me and many other brokers were on a conference webinar with him recently, and this is what his talk is. This is what he told us in that. I'm sharing those wordings actually. So his main thing was that if GST is increased by 1% in Canada, just 1% in Canada, it will bring in $7 billion extra to the government revenue. That's what he thinks. He did not predict, but he thinks that it could be one of the reason. Then other thing that he talked about was carbon tax money, which government is collecting, could be basically used for journal purposes and so on. So the last thing that he talked about was inflation. So the cost of rising prices, right? So prices everywhere. Lumber has gone up. The cost of bread is expensive. Yesterday I was grocery shopping with my wife, and I remember the grocery that we used to buy is. I noticed the bill has gone up. The cost of bread and food has gone up. So, should we be worried about? The question was, should we be worried about? Should we ever lose our sleep over inflation? And his point was, yes, you should worry about inflation. And this inflation is the one more thing. Inflation is cost of rising prices, and you should worry about in the next come 1 to 2, 3 years. This is one of the main thing that will be one of the target. The Bank of Canada, Department of Finance, Government of Canada will be keeping a close eye on it. And his point was, as soon as the money is spent by people, the money that I was talking about earlier, 230 billion extra money that is sitting in the bank accounts, the liquidity in Canada will be lower, and which will lead to basically a higher inflation, right? So then inflation will rise, right? So these are the few things that I listened to him, and through his conversation, this is what basically he talked about. And housing market, yes, he also talked about housing market. So in Canada, the housing market was not impacted that much, we have seen, by the crisis, the COVID crisis, right? Why? Because people want to buy homes. People are working from home. People want more space. And my kids are also at home, so all of us are occupying one room in the home, and we need space basically. So the call was basically that people. The thought process is people need to move out, maybe buy a bigger space and have everybody stay at home. They think that if this is, I was reading through a blog post and a documentary the other day, and they were basically talking about, is the COVID-19 the first wave or like first kind of infection that we have seen, and with the GMOs and everything that is all made up food right now, will these kind of infections be normal for us? That was the talk of that blog, right? So will people always need more space? And with online learning and all schools going offline and everything and working from home, will this be our normal future going forward? So this is what he was talking about, that this whole thing was already there. The online learning was already there. Working from home remotely was already there. But this pandemic accelerated that. So it pushed it more, that now everybody has to do it, right? Earlier it was on a smaller extent, not much, right? So the housing market, why it was not impacted that much, or let's say the why people ask me the same question, why, like, we are in a pandemic and why people are, but there's so much demand for the house. This is not impacted because, as I mentioned earlier, people lost jobs. But which people lost jobs? The low earning income level people lost their jobs. The renters, mostly even Benjamin mentioned, renters lost their jobs. The people who were were basically in a middle income category or high income category. They did not lose their jobs. They were, majority of them, they were in their income level as is, maybe a slight dip. But this recession or this crisis was totally different than the 2018 crisis, because majority of the buyer segment was basically, when the COVID started, they were keeping quiet. They were basically not doing much about it, right? They were watching and seeing what we should do. But as soon as the normalcy came back in July, August, and September last year, we have seen the demands go up. In this January, February, there was so much demand. Everything was basically, the banks were so behind in doing the applications, because there were so many people applying same times. Pre-approvals were taking 8 to 10 business days to get pre-approval from the bank, right? So these kind of things, why? Because the buyer segment in this crisis was not impacted. That's what Benjamin Tal's finding is. His finding is that buyer segment was untouched, and it was a record high segment which was untouched by this crisis. And this is the reason why the buyer segment was there, so the demand was there. When the demand was there, people were buying it. And on top of that, the low interest rates, we should not forget that the low interest rates basically pushed it more, and it everybody wanted to take advantage of that, right? So these were the reasons why the housing market was not that much impacted by this crisis overall in Canada. So guys, I thank you very much for joining. If you have any other questions, I will stay online for next 3 to 4 minutes, and I would be more happy to help you out with any mortgage questions you have for me.